And now, it's time to see what was in your inbox last night. Global Market Apocalypse Edition with Michelle from Payometry Labs.
Hello from the eye of the financial storm. Welcome back to Your Inbox Last Night, the only show where we stay up all night watching the Asian markets so you don't have to. Today's vibe? Somewhere between prepping for Black Monday and panic Googling how to short the entire economy. We're talking market free falls, paused IPOs, stablecoins that aren't securities, according to the SEC, at least for now, and the Fed basically shrugging and saying, let's just wait and see. So grab your cold brew, maybe fire up that Bloomberg terminal for emotional support, and let's dive in. It's Monday, April 7th. Quickly catching you up on headlines. The Secretary of Health and Human Services says the markets are tanking because traders don't have enough omega-3 fatty acids. The President of the United States posted on social media telling the country not to be a panickin', which is his word for panicking Republicans. The Court of Appeals has ruled that deporting a legal citizen of the United States without due process is a descent into lawlessness that the courts cannot abide. And finally, in response to the Chinese government's promise to retaliate with 34% tariffs on American goods, the president bellowed he would raise tariffs on Chinese goods an additional 50%, bringing the grand total of tariffs against every piece of clothing, iPhone, car seat, stroller, and Christmas toy over 100%. Let's get started with today's other DC-related headlines. Morning Brew is reporting that the Fed isn't about to rescue your 401k. Federal Reserve Chair Jerome Powell indicated that an interest rate cut is not imminent, despite significant market sell-offs following President Trump's announcement of sweeping tariffs. Powell emphasized the need to assess the tariffs' impact on inflation and economic growth before making policy adjustments, noting they are larger than expected and could lead to higher inflation and slower growth. Turning now to the big story for today. Liberation Day, fallout dashes hopes for Fintech IPOs. A wave of anticipated Fintech IPOs, including Klarna, Chime, eToro, and Circle, has stalled after Trump's April 2nd tariff announcements triggered market volatility and a sharp drop in Fintech stock values. Industry leaders now suggest Fintech firms may delay listings indefinitely or seek acquisitions instead, as investor appetite wanes in the face of geopolitical uncertainty. The Fintech IPO pipeline has taken a dramatic pause, with several high-profile companies pulling back from public debut plans amid turbulent market conditions. Klarna, the company that lets consumers split their payment over several installments, was previously poised for a $15 billion New York listing. But after Tariffapalooza, Klarna has reportedly paused its IPO roadshow following sharp market sell-offs triggered by sweeping tariffs announced by President Trump. Meanwhile, Plaid, the company behind the technology that allows you to seamlessly connect your bank account to other apps, has confirmed via TechCrunch that it will not pursue a public listing in 2025. Instead, the company raised $575 million through a common stock sale, bringing its valuation down to $6.1 billion from its 2021 high of $13.4 billion. Checking in now on crypto and Web3, Finextra is reporting that Ripple integrates stablecoin into cross-border payments platform. Ripple's RLUSD, a USD-denominated stablecoin launched in December, has been added to Ripple Payments and is already being used by firms like BKK Forex and ISEN to enhance treasury operations. Ripple emphasized RLUSD's global enterprise utility, contrasting it with retail-focused stablecoins. And in a related story, The Defiant is reporting that the stablecoin associated with Ripple RLUSD market capitalization jumped to $294 million after being integrated into Ripple Payments. That's a 21% weekly and 122% monthly surge. The token is also being adopted by new exchanges and NGOs exploring stablecoin-based donations. Reuters reports that Federal Reserve Governor Christopher Waller praised stablecoins for their potential to increase competition and speed in the payments landscape. He noted that innovation in this area should be led by the private sector, not government mandates. It's time for the regulatory roundup. The SEC's Division of Corporation Finance clarified that stablecoins pegged to the USD and backed by low-risk reserves are not subject to registration under securities laws. The ruling provides regulatory certainty for issuers and paves the way for broader adoption of stablecoins, which are sometimes referred to as a digital dollar. FinExtra is reporting that the UK Payment Systems Regulator, also known as the PSR, proposed increased transparency from Visa and MasterCard after finding they raised scheme fees by over 25% since 2017. However, merchant groups criticized the proposal as insufficient and called for stronger pricing interventions. FinExtra is reporting that DOJ antitrust officials have cleared the mega merger between Capital One and Discover. The U.S. Department of Justice approved Capital One's $35 billion acquisition of Discover, stating there was not enough evidence to block the deal. This sets a precedent for how antitrust reviews under the current administration may unfold. Banking Dive is reporting that a federal court blocked the CFPB from enforcing reductions in force and ordered the reinstatement of terminated employees. The ruling also lifted a stop work order issued by Acting Director Russ Vought. The DOJ's attempt to overturn the injunction was rejected by the court, reinforcing the mandate to restore prior staffing levels at the CFPB. The decision underscores a shift in judicial oversight of regulatory agencies. Banking Dive also reports that the CFPB announced plans to revise its 2023 rule for collecting small business lending data, possibly to address ongoing litigation. The agency will issue a notice of proposed rulemaking in the near future to outline its changes. In an about-face to the spin we are used to, Bank Info Security says that, despite launching as a cutting-edge real-time payment system, FedNow faces slow adoption due to weak financial incentives, legacy tech resistance, and heightened fraud concerns. Experts suggest more regulatory support and fraud mitigation strategies will be key to scaling it. And that's it for today's edition of Your Inbox Last Night, where we read every fintech newsletter so you can keep pretending your portfolio is diversified. If you're feeling rattled, you're not alone. Just remember, we've survived worse. Like when Facebook renamed itself Meta, dark days. In the meantime, good luck out there. May your trades be green, your stablecoins stable, and your macro bets slightly less cursed. We'll be here tomorrow with more news, fewer meltdowns, hopefully, and just enough caffeine to power through another night of doom-scrolling Tokyo. Until then, stay safe and stay subscribed.